After studying this module, you shall be able to learn about the derivative market in India, identify basic difference between forward option and future contracts, understand the concept of swaps, analyze the operation of foreign exchange and currency futures. Introduction to derivatives. Derivatives market. A derivative is an instrument which does not have any independent value. Its value is derived from the underlying assets, which can be commodity, a security, currency, bullion, livestock or anything else. A derivative instrument by itself does not constitute ownership. It is indeed a promise to convey ownership. The features of the derivatives are as follows. Traded on exchange. All transactions in derivatives is taken place in future specified date. Derivatives are often leveraged such that a small change in the value of the underlying asset can cause a large movement in the value of the derivative, and hedging device, that is reduce risk. The various types of derivatives are swap, options, futures and forwards. Participant in derivative market. Hedgers. They eliminate the risk associated with the price of an asset using the future and the option market. Speculators. They get extra leverage in betting on the future movement of the price of the asset by using the future and the option contracts. Arbitragers. They are in the business to take advantage of the discrepancy between the prices in two different markets. Economic functions of the derivative markets. The following are the economic functions of the derivative market. Prices in the structured derivative market not only replicate the expectation of the market participants about the future, but also lead the price of the underlying to the professed future level. On the expiration of the derivative contract, the prices of the derivatives come together with the price of the underlying. Therefore, derivatives are essential tools to determine both current and future prices. Second, the derivative market relocates the risk from the people who are averse to risk to the people who can take risk. Third, the derivative markets associate itself with the spot market. There is increase in the volumes in the spot market due to the presence of the derivative market. The reason is the increased participation by the additional players who would not have otherwise participated had there been an absence of the procedure to transfer risk. Fourth, the establishment of an organized derivative market becomes imperative as it is very difficult to control the activities of the various participants in an unorganized market. Therefore, in the presence of an organized derivative markets, speculation can be controlled, resulting in a more meticulous environment. Fifth, various third parties can use publicly available derivative prices to predict uncertain future outcomes. For example, the chances that a company will default on its debts. In a nutshell, there is a substantial increase in savings and investment in the long run due to augmented activities by the derivative market participant. Understanding the meaning of forward, option and future. Forward contracts. Forward contracts are the contracts between two parties whereby one party agrees to sell another party currency at some point in the future for a price agreed upon now. The mutually agreed price in the forward contract is known as the delivery price. The amount of the sale as and when it occurs is customizable to the contract. The buyer agrees to pay the cash at the later date when the seller delivers the currency. If the party wants to reverse its contract, it has to go to the same counter party which can command the price it wants as it is in the monopoly. Problems with this type of derivative includes the difficulty in finding someone to transact with. The contracts are non-transferable and highly probability of the risk of the default faced by the both parties. The forward contracts have very low liquidity as they are not standardized and are entered on one-to-one basis. Features of the forward contract. They are bilateral contract and hence exposed to the counterparty risk. Each contract is unique and on a one-to-one basis. There is no standardization and hence low degree of liquidity. The contract price is generally not available in the public domain. The contract has to be settled by the delivery of the currency on expiration date. Future contracts. A future contract is a standardized contract between two parties where one of the parties commit to sell and the other to buy a stipulated quantity and quality where applicable of a currency at an agreed price on a given date in the future. The contract expires on the pre-specified date, which is called the expiry date, delivery date or final settlement date of the contract. The future contract represents an improvement over the forward contracts in terms of standardization, performance guarantee and liquidity. Option derivatives. An option is the right but not the obligation to buy or sell a specified amount of a currency at a specified price on or before a given date in the future. The buyer or the holder of the option purchase the right from the seller or the writer for a consideration which is called the premium. The seller or the writer of an option is obligated to settle the option as per the terms of the contract when the buyer or the holder exercise his rights. Options on the stock were first traded on an organized stock exchange in 1973. There are two parties in an options contract. One party takes a long position, that is, buys the option, where the other party takes the short position, that is, it sells the option. Now there is a difference between the forward contract and future contract. Standardized versus customized contract. Forward contracts is customized whereas the future is standardized. To be more specific, the terms of the forward contract are individually agreed between two counterparties, while future being traded on exchanges have terms standardized by the exchange. Only the price is negotiated. Futures are always traded on exchange, whereas forward always traded over the counter, or can simply be signed contract between the parties. Counterparty risk. While there is a risk of the non-performance of the forward contract, it is not so in the case of the future contract. This is because of the existence of the clearing house or clearing corporation associated with the future exchange, which takes place the opposite position in each trade, so that it becomes the buyer to the seller and seller to the buyer. It acts as an intermediary for each contract. Liquidity. Future contracts are more liquid and their price is much more transparent due to standardization and market reporting of the volumes and price. Mark to the market. Future contracts are market to market every day to reflect the gains or the losses the party makes by crediting or debiting the accounts of the parties respectively. Hence, profit and losses are settled daily. In case of the forward contract, the settlement takes place on the date of the maturity so that the profit or the loss is booked at the maturity only. Privity of contract. In the case of physical delivery, the forward contracts specify to whom to make the gains or losses the party makes by the crediting or debiting the accounts of the parties respectively. On the other hand, the two parties do not necessarily know each other in case of future contracts. Conclusion of the contract. A forward contract is generally concluded with the delivery of the asset in the question, whereas Future contracts are settled sometimes with the delivery of the asset and generally with the payment of the price difference. Margins. Margin is required to be kept by the both parties with a clearing cooperation in case of future contract. There is no such requirement in case of forward contract. Futures versus option derivatives. Future contracts are agreements to buy or sell specified asset on or before the specified date at a price agreed upon. There is an obligation on the part of both buyer and seller to buy or sell. In case of option contract, the buyer enjoys the right to buy or sell the underlying asset. He does not have any obligation. Future contracts have same risk profile for both the buyer as well as the seller, whereas the options have different risk profile. In case of options, for a buyer or the holder of the option, the downside is limited to the premium option price he has paid, while the profits may be unlimited. For the seller or the writer of an option, however, the downside is unlimited, not capped, while profits are limited to the premium he has received from the buyer. The future contract prices are affected mainly by the prices of the underlying asset. The prices of the option are, however, affected by the prices of the underlying asset. Time remaining for the expiry of the contract, interest rate and volatility of the underlying asset. The buying and the selling of the future contract does not require any payment of the price except for the margin requirement. The buying and selling of the option requires the payment of the premium. Understanding the meaning of swaps. Swap derivatives. Swaps are basically an extension of the conventional swaps in the Forex market, where currency dealers simultaneously sell or buy foreign currency for different maturities. Similarly, derivative swap product involves exchange of the interest or foreign currency exposure or a combination of both by two or more corporate borrowers or corporate and the bank. It may not necessarily involve the legal swapping of the actual debts, but an agreement is made to exchange cash flows under a particular loan. A swap can thus be defined as a financial transaction in which two counterparties agreed to exchange streams of payment or cash flows over a time. Interest rate swaps. An interest rate swap is a contract which commits two counterparty to exchange over an agreed period two streams of interest payments, each calculated using a different interest rate index, but applied to a common notional principal amount. For instance, assume that two companies, namely Alpha and Beta, have entered into the swap agreement. Under it, Alpha committed to pay Beta a stream of semi-annual payments calculated using a long-term Australian dollar interest rate over a period of 3 years. In exchange, Beta committed to pay a counter stream of interest payments using 6 months AS dollar LIBOR. This transaction essentially involves exchange of fixed rate interest for floating rate interest in the same currency, calculated by the reference to an agreed notional amount of the principal between the two parties. The stream of interest paid by Alpha will consist of equal interest amounts calculated at prescribed fixed rate and is known as in advance. Opposite to this, the 6 months LIBOR used to calculate interest payments of Beta is applicable only for 6 months, as once in every 6 months LIBOR rate is reset. There would be as many as dissimilar payments. Hence, in case of Beta, it is the first 6 months interest amount only is known in advance. The swap rate, that is the fixed rate, is quoted as a spread over the appropriate majority current option treasury. Payments on the floating side are usually made flat, that is with no spread on the index rate. Wherever the number of payments to be exchanged through a swap differs between the parties, like in the current example, the normal practice is to split the less frequent payments or combine the more frequent payments as to ensure that there are an equal number of payments. This facilitates netting of the payments. Principal amount is exclusively meant for calculating interest streams to be exchanged. At no points of time is the principal amount physically exchanged. In effect, the counterparties to an interest rate swap aim to obtain an arbitrage advantage by drawing down funds in the market where they have greater relative cost advantage and subsequently entering into the interest rate swap to convert the cost of the funds so raised so their advantage from the fixed to floating or other way around. Currency swaps. Very briefly, currency swaps work like this. An Indian company, XYZ company, took an ECB, external commercial borrowing loan, of 250 million US dollars for 6 years at the fixed rate of 5.5%. After 2 years, remaining time to maturity is 4 years. XYZ company wants to shift this US dollar obligation and wants to pay the interest and the principal in INR. The Indian company fears that INR to depreciate, hence increasing its INR expenditure to service the foreign currency denominated interest as well as principal. It approaches different banks for the swapping its US dollar obligations. BBK Bank agrees to the counterparty for this swap at an 8.5% per annum. Once both parties agree, the following swap payment happens between XYZ and BBK Bank. In the beginning of the contract, XYZ company gives 250 million US dollars to BBK Bank. BBK Bank pays INR of 11,750 million, equivalent of 200 million US dollar at the rate of INR 47 per USD to XYZ company. For the next 4 years, BBK Bank pays US dollar 13.75 million, 5.5 of US dollar 200 million to XYZ company. In return, XYZ company pays INR 998.75 million, that is 8.5 of the INR 11,750 million to BBK Bank. After the 4th year, BBK Bank pays US dollar 250 million to XYZ company. XYZ company returns INR 11,750 million to BBK Bank. The following figure indicates the 3-step in the swap contract graphically. Step 1. At swap origination, US dollar 50 million is transmitted from XYZ company to BBK Bank and INR 11,750 million transmitted from BBK Bank to XYZ company. Step 2. Annual interest payment of US dollar 13.75 million with XYZ company and INR 13.75 million from BBK Bank to XYZ company. Step 3. At maturity, XYZ company receive US dollar 250 million from BBK Bank and INR 11,750 million flows from XYZ company to BBK Bank. Hence, due to the swap agreement, the US dollar interest and principal repayment exposure of Indian company is shifted to the BBK Bank. In other words, swap helped the Indian company to shift its US dollar obligation to INR obligation. Of course, one may ponder why BBK Bank would like to take such an exposure. In fact, BBK Bank may not be taking the exposure at all, as BBK Bank may be exactly an opposite swap contract with some other counterparty. In the first swap agreement with the Indian bank, BBK Bank was paying US dollars and was receiving INR. BBK Bank can mitigate this risk by entering into swap contract with another counterparty where it receives US dollar and pays INR. Of course, all swap contracts are not structured in a manner as given in figure 2, as swaps are OTC contracts. Swaps can be structured in different formats. Swap contract can be used only pay the interest payment only. In such type of swap, step 1 and step 3 are redundant. The swap contract can be used to cover the principal repayment and not the periodic interest payment. At times, the principal is swapped into two different currency. The company may pay US dollar in step 1, receive INR, and receive euro in step 3, pay INR, depending upon the client's requirement. Bank structure swaps with the varying features. Foreign exchange and currency features. Foreign exchange future contracts. An exchange traded forward contract is known as future contracts. Forward contracts are tailor-made depending upon the requirements of the contract buyer or seller. However, being exchange traded future contract are standardized, contract size, maturity period, etc. Being exchange traded future contract can be squared off easily, which may not be possible in case of the forward contract. In case of the future contracts, the clearing house associated with the exchange takes the counterparty risk that the loss making party do not deliver during the maturity period. Traders also have to pay margins, initial and daily margins, as exchanges require all traders to pay margins. In India, Forex futures contracts on INR or US dollar, INR or euro, INR or pound sterling, and INR and Japanese yen are traded at some Indian exchanges like National Stock Exchange and United Stock Exchange. Understanding Forex futures contract specification. Unit of trading of US dollars 1000 indicates that whatever a trader is taking position in one future contract, the trader is taking position buy and sell 1000 USD. For example, if a trader is taking one long future contracts at say INR 45.25 per USD, it indicates that the trader has agreed to buy 1000 US dollars and pay INR 45,250 in future. Tick size of INR 0.25 indicates that the price quotations can vary in multiple of INR 0.25. In other words, a trader can quote a price of INR 45.25 on INR 45.50 on or INR 45.75, etc. But the trader cannot quote INR 45.25. Contract cycle of 12 months indicate that the trader can take position maximum up to 12 months. For example, in a month of August 2011, a trader can enter into the contract to buy or sell future for August 2011, September 2011 up to July 2012. In other words, at a given point of time, 12 monthly contracts are available. Base price indicates the theoretical price based upon the spot rate and interest rate prevailing in both countries, explained later. Price operating range indicates the maximum price variation which can happen on a given day, akin to the circuit filter in the stock trading. Position limit indicates the maximum open position a trader can take depending upon whether a trader is a retail client or a trading member or a bank. Minimum initial margins is the amount a trader pays the moment he/she takes the future position. The open position is also marked to market MTM on daily basis. Based on MTM loss, the trader pays additional margin known as extreme loss margin. MTM margin works like this. Suppose on a day T, a trader takes a long future position to buy 1000 US dollars at INR 43.50. The contract is going to mature after 3 months. On the day T plus 1 day, suppose the Indian rupee has appreciated and is quoting at INR 43.15. This indicates that the trader is buying 1 US dollar by paying INR 43.50, whose value is INR 43.15 today. Hence, the trader is making loss. The trader has to pay MTM margin based on the loss. If the spot exchange rate would have been appreciated, then the trader would not have to pay the margin, but counterparty to the trader, short futures position holder, would pay the margin. To summarize, on day T, the trader pays the initial margin. Every day, the opens position are MTM and daily margin is calculated. Every day, the open position are also settled based upon the settlement price. Settlement price on the expiry date is different than the settlement price on the contract maturity date. On any non-expiry day, the settlement price is calculated as last half or weighted average price. On the expiry date, the settlement price is given by the RBI, known as RBI reference rate. Theoretical price or the base price is calculated by taking into consideration the spot price and the interest rate associated with the currency pair. F is equal to S 1 plus RQ upon 1 plus RB, where RQ and RB indicates the interest rate in India and US respectively. Let us summarize. Risk is a characteristics feature of all the commodity and capital markets. Derivatives came into being primarily for the reason of the need to eliminate price risk. Derivative is a financial instrument contract whose payoff structure is determined by the value of an underlying commodity. Derivative are specialized contracts which are employed for a variety of purposes, including reduction of funding costs by the borrowers, enhancing the yield on the asset, modifying the payment structure of the asset to correspond to the investor market view, etc. There are many kinds of derivatives, including futures, options, interest rate swaps and mortgage derivatives. Forward contracts is one-to-one bipartite contract which is to be performed in the future at the terms decided today. Delivery and payments will take place as per the terms of this contract on the designated date and place. Future contracts are organized, standardized contracts in terms of quantity, quality, delivery, time and place of the settlement on any date in the future. These contracts are traded on exchange. An option is the right but not the obligation to buy or sell a specified amount of the currency at specified price on or before a given date in a future. Swaps are private agreement between two parties to exchange cash flow in the future according to a pre-arranged formula. Generally, there are two types of swap: interest rate swap and currency swap. An exchange traded forward contract is known as futures contract. Forward contracts are tailor-made depending upon the requirements of the contract buyer or sellers. However, being exchange traded future contracts are standardized, contract size, maturity period, etc. Currency futures are standardized foreign exchange derivatives contract on a recognized stock exchange to buy or sell a standardized quantity of one currency against another on a specified future date at a specified price. In the Forex future contract, base price is calculated by taking into consideration the spot price and the interest rate associated with the currency pair. F is equal to S 1 plus RQ upon 1 plus RB.